Singapore and Dubai both market themselves as international business hubs. They serve very different strategic purposes in the global economy. One gives you access to the heart of Southeast Asia's financial system, while the other puts you at the crossroads of 3 continents. Understanding this difference and other key factors will help you decide which location aligns with your business goals. Hi, I'm Ben from Statrys. In this 2-part series, we'll examine Singapore and Dubai through the lens of what actually matters for your business, how simple the setup process is, what business account access really looks like, which markets you can reach, tax implications, and practical day-to-day operations. In Part 1, we'll break down the company formation process, the reality of opening business accounts, and which location gives you better access to your target markets. Let's jump in. Let's start by examining how straightforward it is to register your company in each location. Singapore operates one of the world's most efficient company registration systems, and foreign entrepreneurs can own 100% of their Singapore company without restrictions. That said, there are some requirements you need to be aware of. Every company must have at least one local director. This person must be a citizen, permanent resident, or hold a valid work visa. You'll also need a local company secretary and a registered business address. To register, you can submit your application online through the BizFile Plus portal, and standard company approvals can happen in as little as 1 hour. However, there's a catch. You'll need something called SingPass, essentially a digital passport for accessing Singapore's online government services. Since you won't have SingPass as a foreign entrepreneur, you need assistance from incorporation services or filing agents to complete the process. Depending on your provider and company structure, you can expect typical setup costs between $2,300 and $5,900. That's roughly 3,000 to 8,000 Singapore dollars. Dubai, on the other hand, operates quite differently. The regulatory landscape is newer and continues to develop, which means rule changes might occur more often than in Singapore. Most business owners and entrepreneurs find free zones to be the simplest path for setting up a company. These are designated commercial areas where you can get your company up and running quickly, typically within 2 to 5 business days. And just like in Singapore, you can maintain 100% foreign ownership. Your other option is mainland registration, which allows you to operate throughout the entire UAE rather than being limited to a specific zone. The downside is added complexity. You'll need a local service agent, and the licensing process involves multiple government bodies with their own requirements. Free zone packages start around 10,000 dirhams and can go up to 50,000 dirhams or higher. That translates to roughly $2,700 to $13,600 based on which zone you select and what services are included. Here's the takeaway. Both Singapore and Dubai make company formation accessible for international entrepreneurs. Singapore delivers consistency and transparency with setup costs that are moderate but generally lower than Dubai's range. Dubai offers more flexibility within a regulatory environment that's still evolving, but expect greater complexity and potentially higher costs. Free zone setup costs can align with Singapore's lower range, but at the higher range they can be more than double. Now let's tackle business accounts, often the biggest challenge for foreign business owners. Singapore ranks 4th globally as a financial center, with over 100 institutions and a strong push towards digitization, including 5 licensed digital banks. It's recognized as a leading global hub with world-class infrastructure and a stable, trusted regulatory environment. For companies that meet compliance standards, opening a business account is usually straightforward. Multi-currency accounts are widely available, and cross-border payments can be handled smoothly, making it easier to work with clients and suppliers worldwide. That said, there are some practical considerations. Most non-resident owners will still need to complete part of the account opening process in person, and initial deposit requirements may be higher for foreign-owned companies. If traveling to Singapore is an issue, the good news is that fintech providers like Statrys offer fully online business accounts with multi-currency features. You can apply remotely, avoid branch visits, and often be operational within just 3 to 5 business days. Finally, for online entrepreneurs, there's another major advantage. Payment processors like Stripe and PayPal fully support Singapore-incorporated companies, which means fewer issues with online payments or credit card declines when selling internationally. Dubai presents different business account obstacles. For Free zone companies frequently encounter restrictions while trying to open accounts with local institutions. Minimum deposit requirements typically range from 25,000 to 100,000 dirhams or more, approximately 6,800 to 27,200 US dollars. Mainland companies face additional hurdles: Emirates ID requirements, salary certificates, and extensive documentation. Most account opening processes still require in-person visits to branch locations. Dubai's fintech sector remains less developed compared to Singapore's, leaving fewer alternatives when traditional institutions reject your application. Here's the bottom line. Singapore offers a mature, globally ranked business account environment with strong digital infrastructure and seamless payment processing integration. Dubai provides business account access, but with higher financial requirements and more complex procedures for account opening. Now let's examine what each location actually gives you in terms of market access. Singapore sits at the heart of Southeast Asia, giving you direct access to one of the world's fastest growing economic regions. It consistently ranks among the top locations for ease of business entry and operational efficiency. Plus, its policy framework is highly supportive of startups, particularly in tech, science, and innovation-driven sectors. If you're looking to do business with Southeast Asian countries, such as Malaysia, Indonesia, Thailand, Vietnam, or even India, then Singapore is your strategic hub. Additionally, Singapore's time zone perfectly aligns with major Asian commercial centers, making daily operations and communication much more efficient. Now let's look at Dubai. Dubai serves as your platform for reaching the Middle East and North Africa. The Emirate operates as a logistics hub with some of the world's busiest airports and seaports, plus a time zone that connects European and Asian business hours. Dubai's diverse business community and emerging reputation in sectors like blockchain and digital innovation make it particularly appealing for companies targeting these growing markets. Put simply, Singapore is your natural choice for Southeast Asian and Indian market expansion and tech-driven businesses. Dubai becomes your strategic headquarters for Middle East and North Africa operations or cross-continental trade activities. We've analyzed how Singapore and Dubai compare on company formation, business account access, and market positioning. But this covers only part of your decision-making process. In part 2, we'll examine tax frameworks, operational expenses, and long-term strategic considerations for both locations. If you're considering Singapore for your business, visit Statrys.com and click Get Started. At Statrys, we help international entrepreneurs with Singapore company registration and business account opening completely online, with expert support at every step. Stay tuned for part 2, hit that subscribe button, and I'll see you in the next video.